There are fundamentally three ways of handling risk. The first is transferring it, meaning that one transfers the risk of one particular action to someone else who accepts it knowingly. And an example of that would be when depositors deposit their money in the banking system. They transfer the risk of use of that money to the bank. The bank in turn transfers the risk to a borrower. The second way of managing risk is to shift it. Shift it meaning to completely shift the risk to someone else who either knowingly or unknowingly ends up taking the risk of transactions that has been undergoing. This third way of managing risk is to share. When basically there's a transaction, parties in transactions know the risks and they share it according to their ability to bear the risk. That's essentially risk sharing. One question that we are often asked is, first of all, what is risk sharing and what does it plan to do? And then why would people want to engage in it? The first question is basically Islamic finance or risk sharing attempts to restore the original function of finance to its intermediation for creation of real jobs and real commodities and income and employment for people. There are examples of risk sharing across the world. We are now moving into an era of crowdfunding where basically people try to directly deal between each other, meaning that people who have surplus funds want to get it to people who have deficit funds. This is in a way risk sharing. Crowdfunding has two aspects as it's developed now. One is based on provision of loans and the other one is provision of financing on equity basis. So people are beginning to share risk for one another. The message of risk sharing is that everyone in the society will be better off. Practitioners will be better off if they actually do intermediation of taking instruments that have very low denomination and allowing people to become included in the prosperity of the society. This would require restructuring of the balance sheet. So the banks can easily restructure their balance sheet by taking short-term, medium-term, and long-term structure within the balance sheet, and then collecting all of their assets in short-term, medium-term, long-term, and issuing a security to the market with low denomination that would be traded in primary, secondary markets, so that individuals with little saving, for example, could buy these instruments. And these instruments would be traded in the market. In other words, the market will be used as an instrument of risk sharing. And so the same thing would happen here, where instead of getting 2 to 3% to a depositor and then the shareholders getting 2 to 3%, they manage to share the rate of return to real economic activities. Everyone gains. The depositors gain a higher rate. The shareholders gain a higher rate. The bank themselves will end up with more wealth than perhaps they would if they didn't restructure their balance sheet. As a whole, you will end up with a far more efficient economy. You will end up with far more happier people because now they are sharing the risk and uncertainties of their lives together, and brings people closer together. From every angle, from social angle, psychological angle, economic angle, financial angle, business angle, it's a win-win situation.